Across the globe. Chartmaster says this is the single worst area to be invested in the consumer discretionary space. Why, Carter?
Well, we know that consumer discretion has been underperforming equities in general for a year, and a lot of the big stores and so forth are terrible. But autos within the consumer discretion is a real mess. Let's do a little bit of fundamentals first, and then I'll talk about the actual price charts. This is fundamentals, but it's still a chart. It is U.S. vehicle sales, and what we see here, at least what my eye sees, is something of a rolling or topping out formation. I mean, in many ways, you could say that it's a trend and it's a break-in trend. You know, I mean, however you want to draw the lines, you could say something of a topping out. But again, I want to point out where this is happening in the context of long-term chart. So 18.5 million units, plus or minus. Now, take a look at this. That rolling over action is exactly happening when we were back at all-time highs. Now, I'm going to call those the all-time highs, and here's why. Because those spikes, this is cash for clunkers. This spike is 0% financing and or employee incentives. Hundreds of thousands of people work in the auto industry. So if you were to net out those spikes, we essentially have returned right to the 2000 peak and have started to roll. That's not a good setup. All right. So this is a good index. It actually has got an ETF. It's called CARS, cute symbol, C-A-R-Z. But this is NASDAQ Global Auto Index. And what I've got here is the index itself. And then here is the better part. It's relative performance to the S&P. So what we know is that even as the index has tried to, or not tried to, has gone up absolute, as a pick, it's a disaster, meaning if one could have picked something else, one would have done better. So relative performance is poor. Okay, now, there's the actual, what I just did on the last chart, the point being that even as we've gone higher, you actually are making new 5-year relative lows to the market. It's really bad. Okay. How many stocks? It's 33 stocks. It's 900 billion. Let me just go through some of the names. It's the bellwethers. You've got, I mean, everyone knows these. Everyone probably drives one of these things. You've got a Ford, GM, Toyota, Honda, Daimler. It goes on and on. Volkswagen, Nissan, Subaru, but you've got Renault, Peugeot. Big names, yes? So a big index. All right. Oh, more. Mazda, Porsche, Kia. I mean, now, here is the ETF. I think you could draw the lines like this. And I think ultimately we're going to break to the downside, at least to there, if not more. All right, and let's pick a stock. GM, one way you can draw the lines. Here's another way you can draw the lines. Let's put them together. I think you get a break here. GM, 10% down. I'm looking for a move to these lows at 30. Sell.
All right, and GM reports earnings next week. So, Mike, what's your trade?
I'm looking at the June 33.30 put spread. You could spend 80 cents for that. Of course, that's a small fraction of the current stock price. We have that catalyst, and it takes us all the way out to June. I mean, this really is a technical trade much more than it is based on the historical fundamentals, because based on any of those, many of these stocks look cheap, but we're talking about a big secular shift that's going on here.
Yeah, and this is a short that just feels like it should be pressed. Look at Ford. It's down 10% almost in the last month here. I think that long-term trend line that you drew, that GM, it had that little bounce earlier in the year. It's come back to that. A bit of fundamental news is going to take it right through there. And
you've got trouble that's spilling over. So AAP has been bad. CarMax has had some trouble. Yeah. The great winners like AutoZone and O'Reilly, meaning there's something thematic going on. And you know, the notion of cheap or expensive, these stocks trade at 2 times.
Yeah, and you definitely want to use options to make a short, though, when you're looking at stocks that are trading about 4 times free cash flow or 6 times forward earnings. I mean, this is one of those situations where you could, just based on those cheap valuations, get some kind of a spike. But obviously the long-term story isn't a very good one for them.